welcome to this explainer. Look, today we're doing something a little bit different. We're going to treat this as your own personal wealth strategy session. Using the research and data we've gathered, my goal as your virtual financial planner, right here, right now, is to guide you from simply earning an income to building long-term, lasting wealth. We are going to map out exactly how to protect and grow your assets against risks that you honestly might not even see coming.
Here is our agenda for today's session. We've got 1. Redefining wealth and risk. 2. Inflation and AI disruptions. 3. The asset allocation defense. 4. Lessons from family offices. And finally, 5. Overcoming your behavioral traps. Let's jump right in.
All right, Section 1, Redefining Wealth and Risk. To start off, we need to completely reframe how we view money, and more importantly, the hidden threats against it.
So the absolutely crucial point here is understanding the fundamental difference between income and wealth. High income, well, that gives you choices today. It buys a bigger home, dinners out, maybe some flashy car upgrades. But true wealth is what actually buys you freedom. It affords you early retirement, the flexibility to launch a business, and the ability to leave a lasting legacy. Lifestyle inflation is, without a doubt, one of the biggest obstacles to converting your current income into that long-term freedom.
And this perfectly illustrates how wealth is actually built in the real world. Think of it like the rings of a tree. It's not this flashy, rapid, overnight process. Research consistently shows that the typical financially independent person relies on slow, steady compounding, year after year, rather than rapid-fire trading. They are compulsive savers and investors who have just quietly built their money on their own over decades. Now, mapping your own journey through these 7 stages of financial freedom is incredibly eye-opening. We all start out either dependent or just solvent, basically just surviving our expenses. But as you build up that emergency fund, you reach stability and security. Then, as your investments actually start covering your basic lifestyle, you achieve independence. And eventually, over the decades, you hit freedom and absolute abundance, where your focus shifts entirely to the sensible stewardship of your wealth for future generations. Moving on to Section 2, Inflation and AI Disruptions. Let's examine the hidden dragons that are quietly eroding your financial progress while you try to move through those stages. You might check your investment statements and see your savings account growing, which feels great. But as your planner, I really have to ask you, is that money actually increasing your purchasing power? This brings us to a massively important concept: real returns. This represents your actual gains after accounting for the silent tax of inflation. Think about it. If your investments earn, say, 7% a year, but inflation is running at 3%, well, your real return is only 4%. This is exactly why keeping excessive amounts of idle cash sitting around is a massive silent risk. Your money might look like it's growing on paper, but its real value, what it can actually buy at the grocery store, is shrinking. Now, I want you to consider a completely different kind of inflation, a massive structural economic shift. We are talking about transformative AI, or TAI. Economists are modeling scenarios right now where this technology drastically increases economic productivity, but it does so by displacing human labor. The harsh economic consequence here is that labor income could be radically redirected away from human workers and straight into the pockets of the people who own the AI and the underlying capital. Because future AI labor will likely be allocated based on the wealth you hold, anticipating this shift should literally light a fire under you. It creates this massive, urgent incentive to aggressively accumulate capital right now. Securing your future share of this brand new economy means turning your income into investments today before that technological transition fully takes hold. Which brings us to Section 3, the asset allocation defense. So how exactly do we build a portfolio to defend against these dual forces of inflation and technological displacement? The answer lies in asset allocation. Academic studies continually prove that balancing different asset classes, like stocks, bonds, and real estate, is the most reliable mechanism for reducing your overall portfolio risk while maintaining your expected returns. It is literally described in financial literature as the only free lunch you will find in the investment game. Let's break down how this builds into 3 distinct layers of defense for your portfolio. First up, we have strategic allocation. That's your long-term optimal baseline that completely ignores temporary market noise. Second, we apply dynamic allocation, which allows us to adjust your posture as the broader economic environment shifts over time. And finally, we have tactical allocation, which involves taking a slightly more active approach to capitalize on short-term opportunities in very specific sectors. Section 4, Lessons from Family Offices.
To see this layered defense in action, we're going to look at the wealthiest investors on the planet and benchmark your strategy directly against theirs. Look at this incredible breakdown of how global family offices are allocating their assets for 2025. The smart money, it isn't just sitting in cash hoping for the best. They are aggressively and intentionally diversifying across a really broad spectrum of investments. Notice exactly how heavily they lean into alternative assets here. While 59% is sitting in traditional assets like equities and fixed income, a massive 41% is dedicated to alternative asset classes. They're allocating heavily to real estate at 12%, private equity at 10%, and even gold at 6%. Why? To capture those higher returns and to actively mitigate that inflation risk we were just talking about. And there's actually a brilliant psychological benefit to this as well. By intentionally locking up capital in private markets like real estate and private equity, these family offices totally avoid the daily panic of public stock markets. Because these assets aren't being traded or marked to market every single minute of the day, it smooths out the overall volatility of the portfolio. This gives their wealth the quiet, uninterrupted time it desperately needs to compound. And that brings us perfectly to Section 5. Overcoming your behavioral traps. Because the ultimate threat to this entire long-term strategy, well, it's yourself. Just like a tree needs deep, complex roots to survive a brutal storm, your financial plan needs to be deeply rooted in behavioral discipline to survive inevitable market volatility. If you aren't grounded, the fear of risk and the lure of quick, flashy profits can literally derail decades of careful planning. Behavioral finance shows us that even wealthy investors often fall into 4 major psychological traps. First, overconfidence, which leads to hasty, frequent trading. Second, excessive optimism, creating totally unrealistic expectations. Then there's representativeness, where we rely on stereotypes rather than actual probabilities. And finally, mental accounting, which blinds us to the big picture because we're overly attached to past profits. These traps are exactly what cause investors to abandon their long-term strategic plans and just react impulsively to whatever is leading the evening news today. So to protect you from your own emotional reflexes, we employ something called the 5 years rule. This is a fundamental wealth management conviction which states that you should commit to holding any investment decision for a minimum of 5 years. It's a remarkably simple rule, but it acts as a powerful circuit breaker, preventing the emotional, short-term trading that absolutely destroys long-term compounding. By maintaining a disciplined, long-term plan across all economic seasons, we're talking through the highs and the lows, we weaken that excessive optimism and we control the market panic. This is how we ensure your wealth retains its purchasing power and its ability to support your ultimate financial freedom, no matter what disruptions occur in the world. As we wrap up our strategy session today, I want to leave you with one final vital question to think about. Is your portfolio built for tomorrow's reality, one of persistent inflation and transformative AI, or is it coasting on yesterday's illusions? The time to structure your assets for the future is right now. Thank you so much for joining me for this explainer, and I really look forward to helping you build a legacy of lasting wealth.